So, how are you doing today? On my side, I had a very busy day, right? So I just had a webinar early this afternoon, and yet again, I'm talking to you. And the question for me is, so how do you know that you having a project that is viable, that's sustainable? That's very much important, especially if you are a project developer, because most of the time, what happens if you go through the development process and down the line you find out that it's getting difficult to find people to back you up or to invest into that. So I just wanted us to talk about the fundamental financial insights that could help you for your project, your solar project. But before we go into that, so let me just come back and say, my name is Tony T, founder and CEO of Renewables in Africa. So your clean energy champion. And what we do in this channel is to make sure that you getting all the information you need for you to demystify the renewable energy sector so they become as clear as possible, as clear as water, I would say, right? So if you are an investor, you say, hey, I now want to put all my money or part of my money into the sector, you find in here the information that you need. Or if you are a business, you say you want to go green, turn yourself green, definitely in here as well, you'll find the information you need. Or if you are a professional, you say, I want to get into the sector. I want to do the journey that Tony did about 12, 14 years ago. You will find in here all the information that you need. So that's what it's all about. So how do you contribute? How can you participate? Very simple. I want you, first of all, to watch our live and to ask questions. And as I'm talking about that, I can see there is already somebody, Linda Davis, who's saying, good job, Tony. Good job, Linda, because you're following us, right? So I'm the one having to thank you. So, and that's what it's all about. So leave comments, share the videos, right? And tell us what is that you want us to talk about in general, right? So that we can make sure that we can communicate that with you. So hopefully this makes sense. Is that correct? Good. By the way, this video is broadcasting into 4 channels. So I have LinkedIn, I have YouTube, I have Facebook, and I have Mr. Elon Musk's Twitter now, right? So there's a lot of platform for you to connect. So there's no excuse whatsoever to tell me that you couldn't find me. And the beautiful thing is, if you go, for example, on our YouTube channel and you subscribe to that, I want to do that right now, you haven't done it yet, you see all the videos that we've done before, right? And I'd be surprised if you can't find at least one video that won't interest you, right? Excellent. Now, let's come back in today's topic, yeah? And it's a very much important topic because a number of times, yes, I've seen people coming to me and saying, listen, Tony, I've been developing this project for such and such time, and I struggle to find people who either want to partner with me or want to invest into the project, and I found out that maybe the project wasn't right. Yeah. So usually the first immediate comment I could make is, whenever you go into a project, you want to make sure that you have an off-taker or a client that can pay your bill. Just as simple as that. Simple business principle. So whatever I'm doing as a product, as a service, if I don't have anybody that can pay me, obviously I'm going to have a problem, right? So first of all, it's as simple as that, right? But let's imagine that all of those basic rules of business, right? You find out if you have the right market, you find out, if you have a customer that can pay you, whether that customer is a private customer or government, but they can pay you and everything is okay this side. Now, from this side, you're all okay. You make sure so that the country or the environment where you're developing the project, it's favorable for you to have such a project. Let's imagine everything is done like that, right? Because otherwise, if you haven't done it yet, you definitely want to make sure that you check it out. So imagine you've done it. Now, you want to understand what will make my project viable. I don't know if Linda's still watching us. If Linda is watching us, definitely let us know what is that you think, or if there's anybody else, right? So what is making your project viable? I'm sure there's some financiers watching me, so I want to be a little bit careful to make sure that I'm not talking nonsense, right? Because I have to say, so I'm not a financier, obviously. So at Renewables in Africa, besides spreading awareness about renewables energy in Africa and across the world, we are developing projects, right? More on the CNI space, commercial, industrial. And as you do it, you get to learn a bit of everything, right? And I have to say as well, with the experience I've had working on different projects and also being exposed to many situations, you learn a couple of things, isn't it? Right. So, and that's the job of an entrepreneur. So, having said that, yes, I just want to stress that yes, I'm not giving you financial advice now. What I'm providing you is insight based on our experience renewables in Africa, mine, or the people that I've worked with. So, feel free, please, to go and check it up yourself and check up as well with your financial advisor if you do happen to have one. So, having said that, coming back into the topic, so I can identify 5 elements, right, that you absolutely want to check to make sure that the project that you're developing do make sense, yeah, and you want to track that correctly. So I'm just going to go and list them one by one, and I'm hoping that you are taking note, because if you don't take note, there's nothing I can do for you. Oh, well, if you don't take note, there's one thing you can do. You can replay the video. It's easy these days, right? And you'll be able to pick that up. So having said that, let's move on. So the very first, I would say, element or parameter that you want to be checking is your project cost. Yeah, the project cost is very, very much important. So, how much is the total project of your the total cost of your project would be? Yeah. So you want to make sure that you track that down, and this will be a function of all the activities that you would do when you are initiating the project, developing the project, right, and doing a number of analysis here and there, engaging with people. This is what you call the development phase, right? When you're still initiating work and doing that. And my advice as you're doing it, right? So I would advise keep track of your expenses, because sometimes what happens is you have some developers, yeah, or people, they've been making some expenses, and when they come to the point that they have either a partner who wants to who want to jump into the project, or an investor who wants to jump into the project, that this developer, this entrepreneur is looking to make up for the money he's been spending before and turn it into equity, which we'll call sweat equity in industry jargon, right? He wants to make sure that he can turn it into equity so that he can get a lot more equity into his own project. And obviously, the partner, the investor usually will say, okay, can you show me an evidence of you having spent that money? And most of the time, a lot of them would not have that evidence. So, and they would want the investor or the partner just to trust them just based on their words. And I'm sorry to say, guys, in the industry, this is not good enough. In fact, in any industry, this is not good enough, right? So, how can I know whether what you say you're making that up? So project cost is very much important. So, and in the project cost, you will have the development, that's the initial phase when you're initiating the project. You're taking that to a phase whereby now we can decide that it's good to go. And then after that, you have everything related to the EPC. EPC stands from engineering, procurement, and construction. I believe by obviously deconstructing it like that, you understand exactly what I mean. So you want to make sure that you have a project that is competitive. That's very much important. I know solar has been coming down for the last 10 years, right? Solar project. So, but we could roughly say, let's imagine if you were developing a 1 megawatt project, usually you would have 1,000 per kilo per kilowatt, right? Roughly. I know now it's slightly below that, right? Because the economics are improving. But even if, as we're talking today, because of COVID, because of the situation in Russia, Ukraine, things are climbing up a little bit more, right? So, especially after the announcement of Russia saying that they're cutting gas to, they're cutting gas to put. I shouldn't be laughing, by the way. That's not laughing stock. Apologies for that. I'll just say, yeah, latest announcement is becoming serious. And then I have one of my colleagues who's going to intervene in the next few minutes, who is telling me that the precise amount now it's 960,000 per megawatt, right? So he's a lot more informed than me. So you want to watch out. You want to listen to what he's saying. And like I said, I'm going to bring him on just in a few minutes. So let me just accelerate a little bit so we can get Coffee to join us. So the project cost is the number one. It has to be competitive. And after that, the tariff is the second element that you want to check. Yeah, very much important. And the tariff, that's key. Why? Because this is the money that will be coming in. This is what your customer is paying you. That's why I was saying you want to make sure that you have a customer who can pay you the money. Yeah. So if that customer can't pay you the money, no matter how sweet, how beautiful are your projections, if he can't pay you the money, you go nowhere. So the tariff is important. So the tariff needs to be competitive, right? And in terms of tariff, so obviously if you're talking in megawatt terms, also it depends where you are, whether you're in Europe, whether in Africa or other emerging market, it will vary. In Europe, we're probably going to have something, the low, single digit cents, something like a 5, 6, 7 cents, right? Dollar cents, per kilowatt hour, maybe lower than that because I think the economy is getting better. So in the continent of Africa, for example, in the emerging market, that would be, I would say, between a 7 to 8, dollar cents, all the way to the early teens, right, per kilowatt hour. So that's just a broad idea. Maybe again, Coffee, when it comes on, going to correct me. So tariff is the second one. The third that you want to look at is the borrowing cost. Yes, because solar project, at the difference of many others, require an upfront investment. And that upfront investment is either you, the solar entrepreneur, the entrepreneur who had to bring in this investment, but most of the time it's actually another investor that is bringing that project, and you're borrowing the money. So you borrow the money to the bank or maybe to a fund or whoever. But you want to look at what is the borrowing cost. In other terms, the guy who's giving you the money, right? What is he expecting you in terms of interest rate? Especially when I talk about borrowing time, that means you're contracting a debt. So what is the interest rate for the debt, right? Is it 7% or 6%, 5% that you can get in Europe or in the emerging market where you can go all the way up to 20%? You want to know that, right? Because this is what you're going to be paying later on when you repay all the debt. So keeping an eye on the borrowing cost, vital, very important, right? So like I say, after the project cost, after the tariff, the borrowing cost is exactly what you want. And after that, the fourth element, right? I'm looking to accelerate a little bit because I want to bring in on Coffee, right? It's going to be more interesting when we have Coffee. So the fourth element is actually the split. So the debt equity structure. So how you're going to have it. For example, are you going to have a 70% debt and 30% equity, or maybe 80-20? So yeah, that's what you want to go. You want to go in structure, because that will have an idea. That will have an impact on your borrowing cost in the end, right? So depending how mixture you want to have, because so I don't want to get too technical, because I know that some people watching may not be that knowledgeable in the market just yet. But suffice to say that usually contracting a debt, it's a lot cheaper. So the more debt you have, it's cheaper than actually having equity, because equity, so whoever is investing with you, right, is here for the long run, right? And usually he would invest right at the beginning where things are still very risky, especially at the development stage of the project. And because it's a lot more risky, he wants a bigger return. Yeah. So he may be asking for something like 15%, so on and so forth, whereby the debt is only asking for 7%. That's why many people would like to have a lot more debt, right? So having that structure, debt equity. So what is the structure? You want to definitely make sure that you keep an eye on that. So that was the fourth element. And the fifth element, so if you've been following me, I'm hoping you'll be following me, is the tenor of the debt, right? So how long are you contracting the debt for? Is it for 5 years, 10 years? Okay, let's be honest. Most of the time for this project, we're talking about 10-year-ish and going up, right? It could be 7, 8, but I very rarely say in a bank, lending you money for a solar project only for 5 years. So I've rarely seen that, but maybe again, Kofi can send me something different, and maybe some other people will have a different experience. Yeah. So the tenor of the debt is very important. Why is it important? I give you a typical example, because most of this, especially if you're doing a ground mount solar project, right? you want to make sure that the land, especially if you're leasing the land, you want to make sure that the lease at bare minimum is longer than the tenor of the debt, and even better, it's longer than the whole project lifetime, which is about the 25 years, right? So I'm just saying that because if you are a little bit laxist and you don't pay attention and one can figure out that actually the lease that you're having, it's a 7 year, where your tenor of the debt that you're asking for is 10 years. Clearly, there's a problem, right? So, I mean, what's going to happen for the last 3 years if you're not all of a sudden, if the owner of the land say, I want to take back my land? So you're into a big trouble. So that little thing like that, obviously, it doesn't happen most of the time in the industry because people are a little more careful. But I'm just saying that I'm taking extreme case just in case somebody did not understand that. So those are the 5 elements that I can talk about. So let me just recap that to make sure that it's very simple, and then I can bring in on coffee. So we have number one, like I say, is a project cost. It's very important for you to look at that. Then we have the tariff. Make sure that also is competitive. Otherwise, your project's in trouble, especially because this is the money coming in, the tariff. You want to make sure that it's fine. You want to look at your borrowing costs. Do you have a debt that is affordable, cheap enough for you to carry on with your work? If you have, great. Want to look at number 4, the structure. The debt equity structure. How is it? So is it properly balanced to make sure that you can bring down the cost of an investment or keep it to a level where it's sustainable, making that the return that you're getting from the project are enough to pay off the debt, but also for you to secure the return that you are looking for. So that's important. And the last and fifth element that I mentioned, it's effectively the tenor of the debt, right? So how long that debt is running for, and is it optimized for the project that you are running? So this is that, and all these elements that I mentioned, it's quite interesting and surprising, because not surprising, but I would say normal. So you'll find that in most of the solar software design that are out there. But like I've done for the last few weeks, I've been inviting my good friend Kofi. So Kofi want to come in line, because Kofi, it's the creator and the founder of PV Data. That's a very, very, I would say, revolutionary solar platform that obviously allow you to effectively, in a split second, we're talking about what, less than a minute, you can figure out whether or not the project that you're running is viable or not, right? So Kofi, pleasure to have you again. Yeah. So how you been keeping?
Likewise, Tony. Yeah, pleasure to be here again. Yeah, it's obviously a very, very busy time for the industry. Doing well. It's Wednesday right now, but for some reason, actually working like it's still Monday. But yeah, pleasure to be here.
Excellent. So, I've been talking about those. By the way, thank you for correcting me with regard to the project costs, because those are, I would say, inside out important for people that are in the industry, just to see whereby we are on the market. And I was talking about the fact that, so you obviously build a PV data, right? So and a lot of those elements I have mentioned, I know it's inside the software. First of all, let me ask you a question. Beside those 5 that I've mentioned, is there any other important financial insight that is important for solar design that we will see on your PV data software?
I mean, absolutely. I mean, just to recap of you what you mentioned, the risk factors or the elements that you or the metric or the financial metric that you actually mentioned. Obviously, when trying to measure project viability or project bankability, from a financial point of view, yes, I mean the developers or investors need to take into account the project cost. The project cost for solar right now, global weighted average has actually fallen tremendously right now, a record low of roughly about $960,000 per megawatt, and it's literally just fallen and fallen and fallen. On a competitive level, it is now competitive with the national grid, competitive with coal, competitive with gas, and it's basically fallen and fallen as the year go on. I mean, other metrics that you did mention, the PPA price, the project tariff is also very, very important. Yes, I mean, these are all the metrics that can actually be used on the PV data platform. I think you covered all the main metrics from a financial point of view. So if an investor, if a developer needs to measure project bankability, I believe all the metrics that you did mention, those are basically the key elements or the key risk factors from a financial point of view. But I think what's also important for us to mention as well is, bankability or project viability is not just from a financial point of view. We also need to incorporate, what I call the qualitative metrics, metrics that are not quantitative. The metrics such as, environmental metrics, social metrics, because I mean, those metrics can be, they can make or break a project. For example, I mean, obviously, measuring the project viability needs to assess whether or not that project is going to be exposed to elements like political risk, for example. I mean, with the situation going on in Ukraine, unfortunately, I mean, obviously, it's very, very clear that regardless of whether or not financial bankability may work, on the more social viability, it is not the right market. So basically, you're replicating these qualitative metrics in every single market. So for metrics such as political risk, natural disaster risk, biodiversity risk, deforestation risk. The reason why it's important to actually account for these risk factors is because right now in the climate that we're in, we're basically in a pro net zero climate, we're pro sustainable climate. So projects that are exposed to all these sort of risks, whether it's risk of deforestation, if you want to build a huge 1 gigawatt solar farm, for example, and in order for you to actually build that project, you need to basically cut down a huge forest. On a more international scale, the international community will frown on that technique. So you may or may not be penalized. Certain projects back in the day in Brazil, because Brazil has a very, very rich rainforest, were actually penalized for actually cutting down forests to actually build solar farms. What I'm trying to say that the PV data platform looks into not just the financial metrics that you clearly mentioned, but also the social and the environmental metric relative to the location that you actually want to locate your project. And the icing on the cake for the platform is that it delivers the user basically, as you said, in a matter of seconds, a full-fledged 20 to 30-page due diligence and financial reports covering all the major elements from the financial ability, technical viability of the project, and also the qualitative or the possible qualitative risk that project will encounter during its entire life cycle. So that's basically what PV data is bringing to the picture. Just as a rough background for myself, I have a very, very, I have been a project developer. I've actually developed, utility scale projects in the sub-Saharan region. So I've basically gone through. I don't want to use the word the headaches, I've gone through basically the entire chain of the development stage, from obviously sourcing the land to negotiating EPC contract to trying to determine what the right PPA is to negotiating with the utility and all of those. I mean, that's a very, very challenging aspect. But yeah, so that's my background. I also have a strong software background as well. PV data was developed as part of a doctorate research. So it was developed along at Imperial College London. And basically what myself and the university are trying to achieve, and we believe we have achieved that, is basically to present a tool for the industry to make the development and the decision making for solar energy project utility scale a lot more seamless. And we believe we have achieved that.
Okay, let me ask you a quick question before we wrap up, because we have about a couple of minutes before we turn it down. So obviously, from your experience, I know that you now have a number of users not going through the software, and I'm sure you're getting some good feedback from them. So what is that, would you say, is the one insight, whether it's qualitative or quantitative, that the software has that people seem to be enjoying and they couldn't find somewhere else? What is that?
I would say it's more of the qualitative element, and the fact that the qualitative element has actually been addressed in a more readable format and presented basically as a financial type report. And I think that's what differs us from other competitors out there in the market, for the fact that in just under 10 seconds, any project in any part of the world, in any currency that you want to structure, you can actually use the PV Data. PVData.io is basically the website. You can download the software for absolutely free. And I believe that's what separates us from other softwares out there. Most solar software out there right now, they focus on just one element of the development chain, either just focusing on, let's say, just a technical element, or they just focusing on just a financial element. But what PV Data does is we bring everything together in one dedicated platform, and we present it's an easy to use platform as well. So you do not need to have a huge solar background. You don't need to have any technical background in solar. You don't need to have a financial background in solar. You all just need to do, if you are new or not too familiar in developing or structuring solar projects, is just watch our 10 minutes tutorial video, and we'll basically guide you on how you can actually start structuring your own utility scale solar project.
Okay, no, that's fine, and I very much thank you for that. So just to wrap in a wrap up comment. So I think because you talked about that, I can see you have the link there. That's brilliant. So okay, can you send it maybe in the chat? So I'll make sure that I drop it as well, just in case anybody would want to have a look at that, and that would be kind of useful, right? So that would be okay. Good. So let me just take it. That's in case people want to have a look at that. I'm just showing. It is showing as well. Okay, that's the PV data too. So no, that's very much interesting. So thank you very much, Kofi, for that. And like I say, so it's very much interesting and to hear that in the platform. Okay, you will see all those elements that I've mentioned. Just to recap again in wrapping up comment, that the 5 elements that I talked about today is a project cost. Very much important. You want to make sure that it's very competitive. The tariff, because that's where your money is going to come in from. This is essentially the money that your your client is giving you. So you want to make sure that it is competitive as well. I'll give you an idea. So the project cost, you're looking about roughly 960K per megawatt, right? In dollar term, obviously. The tariff, anything between $7 can go to $11. That's where you tend to go as well. So okay, those are utility scale project, right? But you can also sort of bring that down as well to a smaller project, like for example CNI, right? But obviously, the smaller the project, the bigger the cost is gonna be. And the third element that I mentioned is the borrowing cost, right? Borrowing costs, again, that would depend what market you're operating in. If you're in Europe, in America, it's a more mature market, you're looking at in terms of the interest rate for the debt can go to anything from 2 to 3% all the way to 7%. That's what you tend to have. If you're in emerging market in African countries and maybe Southeast Asian countries, that can go sometime up to 20%, right? I know it's a little bit horrendous, but that's what you see on the market. So you want to make sure that borrowing cost makes sense for you. You want to look at your equity debt structure, right? So do you have so obviously most of the time you tend to have more debt because that's cheap to have compared to equity. Again, in relative terms, depending on what market you're into. So you want to know, is that the 70-30, the 80-20? So with 60-40, you decide which one you want to go for and which one makes sense. At the end of the day, you need to make sure that at the end, you have a cost of investment that is sustainable for you, so that when you have the money that's coming in from the tariff that your customer is paying you on a monthly basis, you are able to pay off that debt, to pay off all the charges you have for the project, and you want to be left with a margin that is sufficient enough for you to make the return that you were looking for. And the fifth and last element that I talked about is the tenor of the debt, right? So how long you've contracted the debt for, right? It's very much important to keep an eye on that. So if you've been able to look at all those elements and everything makes sense and it's okay, and everything, look at the metrics or the default, not the default, they can say the average value that we've presented to you, so most likely you will have what I call a viable project. If it's not the case, my friend, you probably want to revise that. I'm hoping that was sufficiently informative for you. So if you have any comment, drop it there. I want to know what is your comment, what do you think about that. Make sure that you share this video. Make sure that you keep following us, because we're also going to have our next live on Sunday at 2:30 BST time. But for the time being, my friend, as usual, an excellent time with you. So I'm delighted, and I wish you a good rest of your day, and I talk to you on Sunday. So may the sun be with you, and you have a beautiful evening. Take care, guys. And thank you, Kofi.